Hey there everybody, welcome to this episode of Working Class Finances. I'm Ryan and today we're going to talk about investing for your retirement. When I first started investing for my retirement, I really had no idea what I was doing. I just kind of picked a mutual fund at random and I didn't really know the differences between Roth IRAs and 401ks. But since then I've learned a lot and we'll go into that today. So first off, the retirement accounts that I have, my wife and I, we each have our own Roth IRA. I have a 401k through my employer, and I also have an old TSP account. It's basically the same thing as a 401k. It was just what I had when I was in the Navy because that's what they offered me there. So if you don't know, a Roth IRA, you put money in after you've already paid income taxes on it. It grows tax-free, and then when you withdraw it, you can withdraw all that money tax-free. 401k will be pretty much the opposite of that. You put money into the 401k before you pay taxes on it. It gets invested, it grows, and then when you reach retirement age, you can withdraw that money, but then you have to pay income taxes on whatever money you withdraw. So now going into the funds that I have a total stock market index fund and an S&P 500 index fund. Both of these are going to be pretty similar. They're largely going to be the biggest companies that are publicly traded in the US stock market. I also have a small cap index fund to go along with the S&P 500 and total stock market index funds. I have the small cap index fund because it focuses on smaller companies. The other two index funds, they're going to be made up of pretty much the biggest companies on the stock market. And the small cap index fund will give me more exposure to the smaller companies. I also have an international stock index fund. The other index funds I have, they're only US-based companies. So by having the international stock index fund, I can also focus on stocks for companies that are based in other countries. And finally, I have an index fund for bonds. With stocks, you own equity in the company, so you own part of that company and you're entitled to part of that company's profits. Bonds are usually when companies are trying to raise money and basically you're giving out a loan to that company and then they pay you back with interest. Bonds generally have a lower return than the stocks will, but they are also generally safer investments. So I keep bonds in my portfolio for years when the stock market does poorly. The bonds will kind of mitigate some of the damage that's done and I won't lose quite as much money. My retirement portfolio is very heavily weighted towards stocks. I have about 93% of my money in stocks and only about 7% in bonds. I do this because I have a long way to go until I get to retirement, so I'm focused on growing my money right now. I also have plenty of years to make up for if the stock market does poorly 1 or 2 years and I lose money. I have plenty of years to make up that loss with more gains from the stock market. So looking at each fund, I've got about 10% in the total stock market index fund and about 55% in the S&P 500 index fund. You probably don't need both the total stock market index fund and the S&P 500 index fund. They're very similar for what they hold. Their returns are also very similar. I have both. One was in my Roth IRA, the other is in my 401k. I didn't feel the need to change it since they both get about the same returns, so I just have both, but you could easily get by with just one of those two. About 20% of my retirement portfolio is the small cap index fund that I have. Another 9% is in the international index fund, and then about the remaining 7% will be in those bonds. I personally am comfortable with having 93% in stocks and only 7% in bonds right now. I've got plenty of time to make up for any losses in the stock market. For example, in 2018, my overall retirement portfolio had a return of about -6%, but then the next year in 2019 with the same investments, it had a positive return of about 26%, so that more than made up for whatever money I lost in 2018. As I get older, I will start to move money out of stocks and more into bonds. All the funds that I have in my retirement accounts, they're all index funds. I do this because they have very low fees and it can be quite difficult to find a mutual fund that has better returns than the index funds when you take the fees into account. For example, the Fidelity Total Stock Market Index Fund that I'm invested in has fees of 0.015%, and the Fidelity Magellan Mutual Fund has fees of 0.77%. That means the Magellan Fund is about 50 times more expensive to have than the total stock market index fund that I have. So to put that into perspective, if you had $100,000 invested into each of these funds, every year you would pay about $150 in fees for the total stock market index fund. And for the Magellan Mutual Fund, you would pay about $7,700 in fees. The other reason I like using index funds is because they're simple to invest in. I don't need to worry about trying to find that mutual fund that's going to beat the market. In 2019, about 64% of mutual funds underperform the S&P 500. If you go over a 10-year period, about 84% underperform the market, and 15 years, about 91% underperform the S&P 500. So if you just have a S&P 500 index fund, you're already doing better than 91% of the mutual funds out there. Another advantage to investing like this is because it doesn't take a lot of your time to set up your investments. About once a year, I look at all my fund balances. I check to see if I have enough stocks to enough bonds, and if the stocks or bonds aren't where I want them to be, I change my contributions and I buy more stocks or bonds to get them up to where I want them to be. Or if they've gotten way out of control, then I can easily just take money from the stocks and put them in bonds, or vice versa. I only spend about an hour each year looking at my retirement account and adjusting the balances, and then it's good for the rest of the year. So you don't have to follow the same stock to bond ratio that I do. If you want less risk in your account, all you have to do is increase the percentage of bonds that you have and decrease the amount of stocks. Or if you're closer to retirement than I am, you can increase the amount of bonds as well. So that's it. That's how I do my retirement investing. If this was helpful to you or you have any questions, let me know down in the comments.